Jerry. Jerry says, Mike, next year I would like to take a closer look at dividend-paying stocks for my IRA. All right, so I'm sorry, dividend stocks for my IRA account. Could you help me with the search criteria under married puts for these stocks? Kurt had one time mentioned a doctor who uses them by going out far enough where the dividends took out most of the risk growth and being... Okay, what are your thoughts about this thinking? Okay, there's two thoughts on this. So we're talking about the radioactive trading married put structure. And the idea here is we're buying a stock. We do want something that moves a little bit. We want to see some volatility to help us be able to apply the income methods to get good premium to limit or reduce this risk to where we might be bulletproof but still have an unlimited upside. So the structure we look at is 5 to 6 months out in the money put to give us the best controlled risk of single-digit percents. And the blueprint here, of course, discusses not only the proper structure that we use and why we use it, but also the 12 different adjustments that we could use if the stock's going up as we expected, if it's staying neutral. There's a few income methods you could do if the stock's neutral. And if the stock has fallen, there's adjustments you can do based on what you think is going to happen next, or something you can even do right after a quick fall to maybe lower some of the risk as well, lower your cost basis and lower the risk without giving up too much there. Okay, so this is the crux behind Jerry's question. Now, our default married put search follows the basic concepts for opening a married put trade that is discussed in the blueprint, going 5-6 months out in time and so forth. So let's go ahead and go to the search. You know, see, we think Ring Central that Ernie just opened recently with a different strikes. It's been on a good move. You know, Momo, ZTO Express, JD.com, and so forth. Down below, this is what you'd see in every search. Once you scroll down below the results, you have the parameter field where you see what default criteria we're using that you can use as a stepping stone to create your own personal search. As I mentioned, for the default radioactive screen, radioactive trading preferred approach, we're going at least 150 days out in time on the put option. So I'm in the options tab here, everything related to the option. Keeping my risk between 3.5% to 9%. Personally, I'm more somewhere in this range, 3 to 7 and 8%. I want to go slightly in the money, and that's really about it. But we want to look for stocks that have some good volatility, 25% volatility or more. We want some of that good movement to get a reasonable premium to help us adjust that risk, lower that risk, and still keep a good profit on the position. Average stock volume, we want stocks in an uptrend. And then, yeah, we want some good earnings per share growth as well. And we prefer, and many of you have seen this during the live webinar earlier, we prefer to use a basic stock list there, a pre-made stock list, I should say, company list. And we tested it against the other list, you know, just using our list that we are showing here, but compared to the same exact option structure against stocks in the S&P 500, NASDAQ 100, S&P 5-star list, value line, and our list outperformed those. The stock performance of that list outperformed those other lists. Okay, that was in the webinar called Trust the Search Criteria. All right. But anyway, Jerry, there is 3 issues with this search. If you want to add in quality dividend-paying stocks, okay, the time frame isn't an issue. Whether you want to go 1 year out in time, as you mentioned, well, hey, if I have a 5% risk and I find a stock that pays a 5% annual dividend, I've covered the entire risk. I'm essentially bulletproof. Yeah, but you have to wait 12 months to get it, and a lot can happen in those 12 months as well. I'm going to explain a little bit more about that later on. Any dividend-paying stock is going to have lower volatility, which means the income method, the application of the income-generating income methods, just selling a call to create a collar, income method number 1. Bear spread, income method number 6, for example, income method number 5. They're much less frequent to come by because the premiums are smaller because the volatility is lower. What does lower volatility also mean? It means you can lower this risk. You might only be between about 2 to 6.5%. We'll just go 2 to 7%. I take 2 $100 stocks, Jerry, and I look at the same 110 strike out to January of 2020. okay, about a year, a little bit more than a year out in time. One is a dividend-paying stock that has a volatility of 0.15. Buying the stock at 100 and buying the 110 put is probably only going to put me at a risk of 3 to 3.5%. Now I have this other stock that doesn't pay a dividend, is more volatile in the tech industry, tends to bounce around and be subjected to certain things, trade tariffs, China discussion, and so forth and so forth. And buying a stock at 100, buying the 110 put, my risk might be 7%. No dividend. Why would I take that one? Because there's more of a likelihood of growth potential into the 10, 12, 15% range on that more volatile stock than there is on the lower, slower moving dividend-paying stock, unless its sector and industry really gets affected. Okay, really has some good news, really has some strong earnings for the individual company. Okay, so I just wanted to mention that. We're going to keep, you don't have to adjust the time frame. You could force it to be more than that. You could force it to be 300 days out in time to 900. Nothing wrong with that, Jerry. You can fluctuate the risk, but you don't have to. What you do have to do is take out this volatility. Okay? You're not going to find a lot of 2, 3, 4, 5% dividend-paying stocks that offer a volatility of 25% or higher. Number 3, you've got to take out this list. The list we prefer is looking for more volatile stocks. It's looking for stocks that are used for income growth, not based on dividend, but on growth and high earnings. Not typically dividend-paying stocks. 1 or 2 might be in that list. Every time I've run the search and I just took the main search, Jerry, and I put in 1 to 2, let's say a 2% dividend yield in the fundamentals, I only get 1 result, maybe 2. Right? So there's not a lot of securities there. So we got to change that. We got to lower this down to maybe 0.10 or greater. We took out the list and we're going to go no list, but now we've got another problem. We probably want to throw in some other criteria here because now we're open to the entire universe. So the first thing I'm going to do is likely change the average stock volume. This is measured in thousands. I'm going to put it at 1,000. I only want to see stocks that trade maybe an average of 1 million shares per day. Still looking for stocks in an uptrend. Market cap, I might put this up at 2,500, so I'm just looking for mid to large cap stocks. You got a 5% earnings per share growth. You might put in a PE of say 0 to 50, 0 to 70 to control sort of the PE ratio a little bit. Okay, earnings doesn't matter. Now, I think I've got everything I wanted to change in there. And leave the stock price the same, of course. So what did I do? I added a filter, look for mid cap. Want to keep the PE ratio good. I still want a stock that has good earnings. Oh, I'm sorry. That's what I forgot. Percent dividend yield. The main point of your question, Jerry. Here we are. I'm just going to put in a range of, let's say, 2 to blank. Anything that pays greater than 2% or more. Okay, so that's all I changed. I could adjust the risk, but the mandatory thing is to lower the volatility, then maybe increase the volume. Look for mid to large cap stocks. Leave the earnings per share growth, maybe control the PE, and look for a good dividend of 2% or more. Just submit search. I am 100% confident that these are the stocks you're kind of looking for. Archer Daniels, ExxonMobil, Royal Dutch, Union Pacific, Western Union, Eli Lilly, General Dynamics, Honeywell, Cisco, Paychex, Kroger. Some other ones I might have expected to see in there are Johnson & Johnson, a couple of those. I don't think they're trading above their 50-day moving average. This is the search you want for dividend stocks. I've actually covered this in other webinars that I believe are available for Fusion subscribers and Radioactive Trading members, how to set this up. Okay. The risk might be higher than you want. So here, Archer Daniels at 43.31. You're going out, this one's 434 days out, 2021, a 5% risk. Stock pays a 3.2% dividend. But remember, you're going to get 3.2% for the first year, 3.2% for the next year, right? Because this is 434 days out. I'm sorry, yeah, you're going to cross that plus 80 days, roughly. Okay, so you're might get another dividend in there, another quarterly dividend, which might put you at about 4% or so, pretty close to that 5% at risk. So a lot of these are in that range, 434 days out. You, of course, could go deeper in the money. So here's a 3.6% on, let's just say with Archer Daniels. I could probably go up to the 55 and get a 3.2% risk for 434. and collecting a 3.2% dividend. But remember, that isn't covered until 434 days. You'd be holding it for a year and 8 months. A year and 80 days, and you'd likely have to roll it at some point after the first 8 or 9 months, because then the time value is going to start to kick in. But this is the setup you want. If you want lower risk, well, let's just see if we can get it. I put in 2 to 7%. We saw most of those companies were paying around a 3-4% dividend, or 2.5 to 4% dividend. So let's put our risk to be between 1 and 4%. And I'm going to allow this to go 3 strikes in the money, all right, so that we can get that lower risk. All right, here's Cisco, SYY, that's Cisco. Oh, there's Johnson & Johnson. My apologies, it's above the 50-day moving average. 90, 434 days out in time, a 3.4% risk, and pays a 2.2% dividend. Close, but not quite. The September Johnson & Johnson doesn't cover it. 3.9% risk, 2.9. So you only have to make up 1% with income methods. But you have to go deeper in the money. Buying the stock at 133 and buying the 145. I'd say the 140 is probably the best bet here, maybe going out further out in time, which might have been in that other screen. But you can tinker with that. But that's what you have to change, because the criteria we're looking for to follow our preferred method is stocks that have a slightly higher volatility and see more movement for better income methods, which means they're likely not paying a dividend. So we've got to take out the stock list. You've got to take out that volatility requirement and lower it down, because most stocks that are going to pay your 2, 3, 4% dividends you want aren't going to have a 25% volatility or higher on a regular basis. So you've got to change that as well. Change the risk to where you want. Now, the comments you made about an old webinar where Kurt mentioned that a doctor, I forget his name, I talked to him on the phone as well, but a doctor was using married puts that were 1 or 2 years out in time on dividend-paying stocks, and the dividend covered it. Yes, it was, but he had to wait closer to that 2-year time frame, 1.5-year time frame to get the dividend to cover it. Anything else otherwise income method he did was a little bit better. There is a blog article on radioactive trading, and I think it might be on Power Options as well, on something that Ernie did on a stock, because this question comes in a lot. And I think it was 4 years ago, end of 2015, beginning of 2016, when Ernie and I were getting this question frequently about, should I be opening on dividend-paying stocks? How can I be bulletproof from the beginning using a dividend-paying stock? We're not bulletproof from the beginning. A lot can happen during that holding time period while you're expecting to collect all the dividends, Jerry. But what Ernie decided to do is he put his money where his mouth is. And you can see this on the historical track record in Fusion as well. Ernie's NLY, Annaly Capital Management Trade, opened several years ago. And the reason why he took this one is because at the same time similar questions were coming in of, why not just take a married put position that has a 6 or 7% risk on a stock that's paying a 13% dividend? You're guaranteed to get a 6% return. Okay, the market's not that dumb. As much as we'd like to think that the people on the other side of us, the people at the exchanges are silly people and morons. We know they're smarter, just as smart as we are, and we know they're very intelligent as well. This is priced in to the married put structure. Okay, so you're going to see risks on a $9 stock. I could buy a 12-strike put. We're going to take a look at that in just 1 second. That might have a 14 or 15% risk. You think normally if I bought a stock at $9 and bought a 15 put, I'm only looking at a 1% risk. I'm 6 points in the money. That's close to 60% of the stock's value. I'm really deep in the money. It should only be a 1% risk or less. It's accounting for the dividend. Okay, so let's go to the custom spread tool. And we'll go to NLY, and I'll go as far out as, not far out as I can. Let's 805 days, don't want that. Let's go to 434. We're going to do a couple strikes in the money here on the put. There's the, that's not too bad actually. The 12, the 15 you see is midpoint's going to be somewhere in there. But let's go to the 12 strike put. So we're going to buy 100 shares of NLY at 100. We're going to buy 1 put at midpoint for 434 days out. See, the risk is 8.7%. That's fantastic. If I hold on to it, I get a 13% dividend on the underlying stock price. But now there's 2 things you got to remember here. two quick things you've got to remember in your mind, Jerry. Do you see it already? You're getting a 13% dividend currently based on the underlying cost basis of 912. This risk of 8.7% is not on 912. It's on the monetary risk of 114 against the total investment of 1314. So what does that mean? The annual dividend payment of 13%. Oh, sorry, I got out of that. I'm sorry, folks. I got out of that there. Let me go back. I've seen that. I can do it in my head, but I just want to see the numbers here. Let's just go back to that quotes page. So the annual dividend of 13% is $1.10. But that's okay because we're going 434 days out. We've got an extra 80 days. We might get an extra dividend depending on how they fall. But that's key. This isn't a guarantee of 4.3%. This risk is based on the monetary investment of stock plus put. This dividend is based on stock. So what happened to earning? There we go. What happened to Ernie? He had a similar position, but NLY at the time I think was around $12 or $13. And I think he bought the 15 put. So he had a married put that had a 12.9% risk off of the total investment. And the dividend was around 12.8%, 12.9% on the underlying stock price, not the investment itself. Long story short, what happened? Well, he held it for 11 months, I believe, close to the full 12 months. This was a 14 output. I think he bought it around now, November, for the following January. So it was about a 14-month output. He held it for 11, almost 12 months. I think he closed at the beginning of December, 30 to 40 days before expiration in January. He collected his 12.8% dividend. The stock didn't really move much at all during that whole time period, and he essentially closed out at break even. Now, this is an extreme example. This is why we don't do or ever advocate using the radioactive trading technique with these REITs and things that pay an 8, 10, 12% dividend, because more than likely, you're just going to break even. Holding a position that long that doesn't move, we want movement. And you say, oh, well, you can do the income methods and sell premium during that time period so you can get away from break even. If you just collect another 4 or 5%, hey, that's 4 or 5% return for the year. But look at the call premiums. Let's go out 21 days. Remember, I was buying the 12 strike put. There's nothing here. There's zero bid. The at the money is barely anything, 3 cents for just slightly out of the money 28 days. Let's go 42 days out in time. 1 or 2 cents premium for the out of the money 10 strike. There's not a lot of opportunity to generate premium on these positions because of 10, 12, 13% dividend. So that already put his money where his mouth is. He wanted to see how it worked. He wanted to see how it worked out. He held that position for almost 11 months and broke even. Got his 12.5, 12.6% dividend, but had to start with a 12% risk. Or, as I mentioned, he started with a risk was 114 that was 4 cents, $4 above the annual dividend, which was 110. But this is not a 5% guaranteed profit, because remember, this risk is based on this amount, stock plus put. Dividend is based just on the stock. So $1.10 off 912 is that 13%. This is not a guarantee of 4.3% profit. That's what you have to take a look at. That's what you have to realize. Okay? So, that being said, avoid the large ones. Nothing wrong with looking for a dividend-paying stock and using a dividend-paying stock for a married put position. On average, usually about 20 to 25% of my radioactive trades are in dividend-paying stocks. And a lot of times, as I mentioned, I will use that exact screen we talked about where I take out the list that we use on the defaults. Got to lower the lower the stock volatility. You can lower the risk, and then put in your dividend that you want to see. Oh, I'm sorry. And it's very similar to, oh, this is the webinar account, not my actual account. On my actual Power Options account, I have a specific Mike's Dividend radioactive criteria, which is exactly what I just showed you, going that way. All right. And real quick, Daniel's question that he asked earlier, and I'm sorry I didn't get to it. I believe he's actually had to leave the webinar. But Daniel's question is, Have you ever considered doing the married put structure with Forex, with FX futures? And how would it work? Is it just as effective? And the answer is no. Okay. Forex is Forex futures and futures market is an entirely different animal. Okay. You can't own the underlying because it's all based on futures prices. You can get this similar structure, not a parity, but a similar type structure, maybe using a synthetic, which takes on a lot of risk because of the high margin of futures. What's a synthetic? You buy an at-the-money call, sell an at-the-money put. So I've got a long call position combined with a sort of naked put with my extra long put position that I would normally buy. What does that give me? This gives me a synthetic stock position combined with this, and you get a married put structure, essentially. But you're buying a Forex call, selling a Forex put that's covered sort of by this long put that you're also buying to mimic this as well. The margin requirements on that based on Forex pricing and Forex margins might be very, very extreme. I'm not familiar with them because honestly, I don't trade Forex personally. And then one could say that you could just do this, by buying sort of an out-of-the-money call. Wouldn't that be equal to an in-the-money married put position? And the answer is not really, because remember, when you buy an out-of-the-money call on a stock, index or ETF, or on Forex, you are taking on 100% risk of whatever you're investing in the option, or 100% risk on the margin that you have to use for that futures contract. What does that just mean? Okay, it means that the risk is higher and the risk of over trading is higher. It's not a parity trade. The parity trade to the married put, we discussed this last week, I believe, is actually buying maybe an out-of-the-money long call, but leaving the same cash you would use to buy 100 or 200 shares of stock, however many contracts you're buying, alone in your account without trading anything else with it. So now you can say, look, Mike, I'm not buying the stock at 50 and then buying the 55 strike put on that stock for $8. So I've got $5,800 invested, but I could only, in that case, lose $3 maximum, or 5.6%. Right? That would be $5,800. And you could say, well, Mike, instead of doing what you're doing, the exact same trade is I'm going to go out and I'm going to buy that same 5 or 6 month out 55 strike call for $3.10. Okay? Now we're at an even risk-reward ratio. You're risking $3, I'm risking $3.10, but I didn't put up $5,800. I put up $310. Now let's say you and I both had $6,000 to invest out of a $50,000 account. We wanted to open a new position. I buy the married put here and use most of it, so I've got $200 in cash left over of what I had left to trade in my $50,000 account, and I've got a nice low-risk position. You buy one call at $3.10 and say you're even to me. You're sitting on $5,700. What are you going to do with that $5,700? The only true parity is if you leave that $5,700 alone in your account and don't use it to trade in anything. But what are you going to do? You're going to take that $5,700 and you're going to buy 5 calls on stock XYZ, 3 calls on stock ABC, 6 calls on stock 1, 2, 3. Now you've got $2,800 exposed to the market of the $5,000 you had left to enter into a position, or $6,000, I'm sorry, you had left to enter a position. I've used my $5,800, but I'm only risking $300 in the worst case scenario. You're now risking $2,800. Okay, that's the over trading. That's the risk of trying to do the synthetic in the futures market, is the risk of over trading, taking on too much risk. But Daniel, those are the 2 ways you might consider it. The synthetic futures, using the synthetic stock structure of selling an at-the-money put and buying an at-the-money call, which may be a debit or may be a credit depending on the prices. That's your synthetic stock, and then you buy the put on it that you would for the structure of the married put we advocate. Or buying the out-of-the-money call, but you just have to be very careful because it takes on 100% risk. You're not in the proper position size. You're not in the proper structure. This doesn't even just go for Forex. This goes exactly as well to using standard options. The out-of-the-money long call is not a parity to the married put position by itself. Because you're risking 100%, you run the risk of overtrading, and you're not going to leave that money aside on hold in your account. You're going to use other trades and expose more of yourself in the market. Okay? It's not to saying there's not a place for buying out of the money calls or doing straddles around earnings or taking a portion of your portfolio for profitable, high probability credit spreads or iron condors in the right market conditions, as we talked about earlier in today's presentation. What I'm saying is those structures, those high-risk leverage structures, out-of-the-money long calls, straddles around earnings, bull put credit spreads, should represent a much smaller portion of your portfolio, so that if the worst-case scenario happens and you do take the 100% loss on those trades or on the one trade in that high-risk leverage structure, that you've only taken out 3, 4, 5% of your total portfolio, and you can live till tomorrow, and the next day, and the next day. That's one of the benefits of married puts. It forces you into that proper position size. There's a place for all these strategies. Now, as we already shown with Paul's questions earlier, it has to match the market conditions for the strategy, and you've got to practice proper position sizing so you're not exposing too much of your account into these more leveraged trades such as credit spreads, speculating buying calls and puts, and even using straddles and strangles around earnings. That has to be a smaller portion of your portfolio because there will be months. The first month, we talked earlier about the iron condors. That first month of 2018, remember when the stock was, the stock was really, really moving up in value. Oh, there we go. When it was really, I'm just going to scroll here for a moment. Oh, okay, there we go. 2018, January of 2018, this section here. The iron condor positions for that month with the movement there, 2 out of the 3 took an average, lost on 2 out of 3 trades with an average of 94% loss because of such, not even this quick movement here, we're talking this in the upside. The bear call sides got cut out quickly for 98% and a 92% loss there. And then, of course, Tesla ended up with almost a 62% return. It was a high, this was coming off that December low, so the volatility was still high at that point getting into the January position, so Tesla had a huge return. But those other two, but this resulted in a 48% loss. So if you had invested $5,000 into iron condors at the beginning of 2018, well, following the criteria I did in that scenario, that would have been a 48% loss. So I started with 5,000. I'm now down to, what did I have here? My numbers here, oh, it's not on this page, it's on the other page, I'm sorry. Yeah, I'm sorry, the 49% loss actually would be down to 24.90. Roughly, it was a 24.85, $2,485 from the 5,000 we started out with. No, I'm sorry. It's 25.15. I'm sorry, it's 25.15. My apologies. Anyway, 2,515. So now this next trading cycle, you're only investing the 25.15, and you would have gotten hurt on the bull put side. It was very tough. You had to borrow money at this point to stay into iron condor positions. And yes, you started to have success later on, but those first 2 months were kind of drastic. Great return and great premium came in because of after the lull of December 26th, the VIX was still high. But this rocket ship up just took out the bear call sides on most of the trades. That was the problem. So proper position sizing and any position that can take 100% risk, buying a call, bull put credit spread, 100% of the margin requirement or more, have to make sure that it's only a smaller portion of your portfolio. So if the worst case scenario does happen, you only lose 3-4% of your total portfolio. All right. Well, ladies and gentlemen, I want to thank you for joining me today. Discussion on iron condors, a discussion on the married put position and using dividends, discussion on rolling down naked puts for Jimmy as well, and why we might not consider using Forex for these types of strategies. For the married put, you could do the synthetics, but it's not really our forte, but that's how you might look to do it. Just want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. Options involve risk and may not be suitable for all investors. If If you haven't tested out the tools on Power Options, we saw the portfolio tools today, being able to link to the management techniques and the rollout opportunities, evaluation of those. We looked at the search, setting up the search for the married put and the iron condor. You can have access to all of those tools plus more by just going to powerop.com, putting in your name and email address. You'll have full use of the site for 14 days. After that, the subscription services start at $45 per month. We do offer other higher levels of service based on if you want historical data or real-time quotes. We already showed today the link to the webinars for Jimmy to go ahead and talk about that managing naked put positions webinar that's available on that page. There's also some other free education at blog.powerop.com, and you can always check us out on YouTube as well. Ladies and gentlemen, it is 6 p.m. Eastern Time. I want to thank you for joining me today. I want to thank you for your questions, of course, and for the spirited conversation. I just want to remind everyone, if you think of any questions later on, you can go ahead and send them to us at any time, support@powerop.com or support@radioactivetrading.com. In addition to that, you could also call us during market hours at 302-992-7971. And if you're currently on a trial or you're a subscriber to Power Options, you can schedule a coaching session at any time. That's a 35, 45-minute, 50-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Ladies and gentlemen, thank you again. Have a fantastic weekend, and we'll see you soon. Good night.